This is Ash Heatwell, Director of Wealth Management at Graves Light Lenhart. Based on the positive feedback received from many of you, we are opting to communicate via video not only for our quarterly newsletters, but also for our shorter monthly updates in between. The purpose of these short monthly updates between quarter end is to provide insight as to what we've observed in the markets during the prior monthly period, while also pointing out if a useful takeaway or trend which we've observed in the form of a chart of the month. We continue to welcome further feedback from our clients. On the right side of the slide is a performance table which provides returns across major asset classes for the month of July, year to date, and for the last 12 months. You'll observe that for the month of July, equity returns were generally positive, as we witnessed a combination of lower than expected inflation data combined with supportive economic trends which provided a supportive backdrop for markets. Importantly, we also started to witness a broadening market recovery relative to the first 6 months of the year, in which 7 individual stocks drove over 70% of the S&P 500 returns. Separately, as interest rates increased across multiple points on the Treasury yield curve, performance for fixed income was mixed to slightly weaker, as pointed to on the bottom right of the table. This is our chart of the month, which shows inflation trends as measured by headline CPI, an informative measure to reflect the year-on-year price changes for a broad basket of consumer goods. Encouragingly, headline CPI has moderated from its peak last June when the year-on-year measure spiked to 9.1%. Note that the most recent 3% year-on-year increase for the month of June is one of many inflation readings monitored by the Federal Reserve, with the indicated measures by nearly any standard still running well above the 2% long-term inflation target. What the chart is showing is that going forward, the comparable data for inflation becomes more challenging. Mathematically, this is because with each new month of inflation data, the prior year data is removed. For example, for the month of June 2023, the month-to-month increase for CPI was 0.2%, which was slightly below market expectations. Were this positive 0.2% month-on-month trend to continue to the end of this year, CPI would actually end up increasing to 4% at year end. The reason being is that the easiest comparable period for inflation is now behind us, as inflation readings experienced their greatest surge during the first 6 months of 2022. Those measured periods are no longer in the equation. In short, the easiest part of what's commonly referred to as disinflation is likely behind us. The takeaway is that while we do not reject the possibility that inflation can eventually make its way lower, we believe it may take longer than what's currently priced into the markets, and a good reason to err on the side of caution. Thank you for your time and interest. As always, please let us know if you wish to discuss these items or any other issues related to your financial planning needs. We are here to help.